Hello viewers, welcome to this first series of our financial literacy sessions, and this is coming to you from Mathematics, Economics and Finance Online School. What we do, we help you master mathematical economics and finance, whether you are exploring the fundamentals of financial management, diving into advanced investment concepts, or preparing for exams in corporate finance or economics. Our goal is to make complex topics clear, practical, and easy to understand. We cover past exam questions, detailed explanations, and insights tailored to boost your confidence and understanding. Now, we give these three subjects an approach that is unique. We give it a touch that is different, one that makes the concepts easy to blend into your daily activities. Now, the problem at hand, the reason why this video exists, the problem at hand considers a scenario that is faced by a board of directors, and we know that this is the team that is charged with making important decisions that determine the financial direction of an institution. Now, this particular board is expected to have some knowledge about accounting standards. It's also expected to have some knowledge about basic policies that govern how the operations of particular establishments are supposed to be guided. Now, we have situations where in the process of executing such duties, they are faced with scenarios that make it difficult to actually understand what to do in line with the regulations, policies, or standards that are in place. So a company has completed a transaction not covered by existing accounting standards, leaving directors unsure how to account for it. They face temptation to choose the treatment that maximizes profit, risking financial misrepresentation. Now, the challenge is to adapt an accounting policy that fairly represents the company's financial position. Now, there are several scenarios that can lead to this particular scenario that we have in place. One would be where a company receives a large grant or subsidy from the government, and there is no clear instruction or guidance on how to utilize it. Board of directors may be tempted to declare profit on the basis of that huge sum that is received, and as much as that is declared as profit, it may give a wrong indication of the financial health of that particular company. So in such a case, directors would have been deemed to have made the wrong decision simply because there were no existing or clear guiding accounting standards to that particular context of problem. So that is one case that we may have. Another case where we may have such kind of a crisis is when a company has invested hugely in carbon sustainability projects. Now, in this case, such a company may be receiving carbon credits, and normally these carbon credits are spread over a period of time, but it is paid at once, lump sum. Now, in the event that a company receives such, if the board of directors are not wary of the fact that that particular figure should have been spread to cover some other years and declare it immediately, then again, that would give a scenario where profits are declared, and yet the true position of the financial health of the company is not revealed. So those are the dangers that we see with such kind of scenarios, and how expensive such kind of decisions can be in terms of having to ensure that the company is an ongoing concern. Now, so how should this team navigate around such kind of a scenario? So one would be to adhere to a systematic approach to selecting an appropriate accounting policy. And here is a structured process that we expect that, if followed to the letter, then the kind of decision that shall have been arrived at will be the one that serves the interest of the stakeholders and shareholders equally. Now, one, consult relevant accounting frameworks. Directors should first refer to the applicable accounting framework, such as International Financial Reporting Standards, that's IFRS, or generally accepted accounting principles. They should review the overarching principles and concepts that guide accounting practices, including relevance, reliability, comparability, and consistency. Now, we are saying these are the overarching principles and concepts that guide accounting practices. So we'll see later some of these standards, what they specify in terms of when to declare revenue, etc. Second, assess similar transactions. They should look for guidance in accounting standards related to similar transactions or events, because as much as situations can be unique, there must be some other similar scenario or event that you can use to benchmark. So while there may not be a specific standard covering the transaction at hand, understanding how similar situations have been treated can provide insights into acceptable accounting policies. Now, again, consider professional judgment. Directors should apply professional judgment, considering the substance of the transaction rather than just its legal form. Yeah, since at some point we may be so tied to the fact that if you do this, then I'm going to I'm going to actually break the law. So it's not about just doing what is legal, but it's also about doing what is essential for the sustainability of the good health of the company. So they should evaluate the economic reality of the transaction and determine how it aligns with the company's financial position and performance. Now, evaluate impact on financial statements. Now, the three financial statements we have is income statement, balance sheet, and cash flow. Now, they need to analyze how different accounting treatments would affect the financial statements, including the income statement, balance sheet, and cash flow statement. So, in essence, what we are saying that in a serious company, there is need for directors to have some basic knowledge of accounting in terms of what the policies that govern such, how they so that they are guided on how to deal with the documents that relate to that field, like the IFRS, etc. So this includes assessing how the choice of accounting policy will impact key financial ratios and metrics used by stakeholders. Yeah, because every time these statements are made public, stakeholders can access the financial ratios, and using such ratios, it is easy to assess or to know the financial health or the extent to which the business is a going concern. And these indicators at some point they may make because if say shareholders get an indication that you are driving the company to a wrong decision, they are likely to make your life difficult, either by replacing you or another company which is stronger, which is doing well and has got the right board in place, board of management or directors in place. You may risk being bought by such particular company. So there is a risk in making wrong decisions, especially when you are at the top or at the decision-making level of a company. Consider stakeholder interests. Directors should weigh the interests of stakeholders, including shareholders, creditors, and regulators. They should consider how their choice will be perceived and its potential implications for trust and transparency. Yeah, because mostly I think what creates a lot of problem, and to some extent, it also determines the value of the share price of companies, is how much you deal with agency problems. So by being transparent, some of these are eliminated, and the fact that the public can build some trust in your brand or your company, that is what increases the value of the company. Document the decision-making process. Now, as you sit making that decision, as much as you may be indifferent about making one decision or another, there is need to document systematically how you arrived at that particular decision, so that in the event that stakeholders seek for an explanation, you are able to give a document that gives your guided steps. And in that way, that document will serve as a future audit, and it ensures accountability, so that the decision, the stakeholders or shareholders will understand that, yes, faced with the same kind of circumstance or scenario, we would have more or less just made the same decision. So making the document, documenting the decision-making process and making actually making this public to your stakeholders or shareholders will be helpful after that particular process. Then consult with external auditors. Engaging with external auditors can provide additional perspectives on the appropriateness of the accounting policy selected. Auditors may have insights based on industry practices or previous experiences with similar transactions. Then ensure compliance with the principle of prudence. Directors should be cautious and ensure that the accounting policy selected does not overstate the company's profit. Yeah, like just the scenario I've mentioned. If for some reason a company received some huge payment in form of carbon credit, the accounting principles may not exist to guide on how such should be spent. And again, also knowing that such carbon credits are spread over a longer period of time, it should be known as to when which payment should be declared, because if it's declared at once, it will be giving a wrong position of the financial status of the company. Monitor developments in accounting standards. I think once someone is a board of directors in a busy company, there is need to be informed, because a number of decisions are made in boardrooms that they are actually they are ones that require that you be in sync with the modern, the emerging trends, to say so. And so for one to keep updated and be relevant, so that your contribution is seen to be one that is guiding towards progress, there is need to be informed, and more particularly concerning accounting issues, because most decisions made in the boardroom, mostly a number of them are managerial. They concern human resource aspects, but mostly they are policy issues. They give direction to the company in terms of the mission and the vision of the company, and much of such are driven by resources, which is money. So for that reason, there's need for directors to remain informed about any future developments in accounting standards that may relate to the transaction. Now, this includes monitoring ongoing discussions in the accounting community and being ready to adapt if new guidance becomes available. Now, I know joining an accounting community, one does not necessarily have to be an accountant, but of course, some basic qualifications are required. But it is necessary, and it is so useful that if one is serving in such high positions, you actually get attached to one, a serious one. Next, consider disclosures. Regardless of the accounting treatment chosen, directors should ensure adequate disclosures are made in the financial statements regarding the nature of the transaction. This relates to what I've just discussed, and the accounting policy adopted and any associated risks. So disclosure on the nature of the transaction, the accounting policy adopted, and any associated risks will give the stakeholders or the shareholders the full picture of why you are there, why you have actually adopted that particular policy, and the potential risks that may face the company as a result of picking such kind of policy. So of course, we weigh the risks and the returns that would be expected. So transparency in disclosures help users of the financial statements understand the rationale behind the accounting treatment. So we say that by following this structured approach, the directors can select an appropriate accounting policy that is not only compliant with relevant standards, but also reflects the true economic reality of the transaction, ensuring the integrity of the financial statements. Now, there's a general requirement that the financial statements give a true and fair view Now, amongst other things, that any treatment gives a realistic and representative treatment of the transaction. It cannot be accounted for in a flattering way just because it is not the subject of a specific regulation. So, like in the UK, Financial Reporting Standards 18 gives some guidance as to how the policy should be selected. For example, the objectives of relevance, reliability, comparability, and understandability should be applied. Now, the directors might consider looking at the treatment laid down by standards for similar balances. Even though those standards might not be strictly applicable, that would ensure that the logic underlying the chosen treatment was consistent with good accounting practice. Now, about some of these standards, you can Google, you can visit some of these sites for professionals. You'll get the accounting standards as required, including the financial and reporting standard that is mentioned here. Now, these are documents that give a guideline that accounting bodies globally benchmark their policies and standards with the guidelines that are given. So I urge you to go ahead and try to get a copy so that if at all you are serving in such a role, those are documents that you cannot do without. So up to there, I want to stop, and I urge you to follow me. This is Mathematics, Economics, and Finance online school. We are empowering minds, mastering numbers, and shaping futures. So up to there, see you in my next video if this interested you.